Let me start by thanking Valerie and Dwayne for inviting me to come out and talk to y'all and tell you a little bit about myself and a little bit about our company. Jim Emerson, I'm the president and the founder of our company called Associated Mortgage Investors. We're a full-service residential and commercial mortgage company. I worked as a commercial banker or a mortgage banker for over 50 years, and that includes 17 years as a bank president. Most of our loan officers are also ex-bankers. We're one of the largest and perhaps the largest asset-based lenders in the Houston MSA. We've got about 50 million out in loans. We have lines of credit with 12 different banks. We've got actually a lot more credit than we have good loans to fill those lines of credit with. But I think a story that a lot of people like to hear, I'm often asked, well, how did you start this company? And the truth is, it just evolved. It really didn't start, it just evolved. I was having lunch one day with a friend of mine. I had left banking because that's when they started branch banking and you couldn't make any money. I was making more money just investing than I was as a banker. He was complaining because he said he's trying to get a loan for this client of his, and just passing pleasantries, I said, well, how much did the guy want to borrow? And he said, well, $50,000. And I said, well, what's the property worth? He said, well, at least 100. And I said, well, I've got some money. I have a background in banking. I'll make that loan. And so I did. I just funded the loan with some extra money that I had. And a couple of weeks later, he came back and he said, you know what, Jim? I've got the same kind of situation, a very similar scenario, low LTV, a good borrower, but he's got to refinance his property. And I said, well, that sounds good to me. I'll make that loan. And as Paul Harvey would say, you know the rest of the story. So that's kind of how we got started. We have like 50 million out in loans. And in 25 years, we figured this up the other day, we funded in just about $500 million in real estate loans. That's a lot of loans. But we have a lot of turnover in what we do, so it's not uncommon for us to make a loan and 6 months later they can qualify to go to a bank or somebody else. And then, of course, at that point, they'll pay us off. Now, we're not too concerned about credit. We want two things. We want you to have equity in the property, and we want to be comfortable in our own right that you can afford to repay the loan. And that's to your benefit, because in our business, there's a term called loan to own. We're not in that business. We don't want to own your property. And I tell you, it's a mistake for the borrower, and it's a mistake for us. And we also think it's a mistake if you get too highly leveraged. Most home builders that I've known, and I've been doing this for over 50 years, most home builders get in trouble when the market is rocking and rolling, they have too much inventory, and when the music stops, they don't have a chair, and y'all know that to be true. So we think, we just believe in having equity in the property. And I'm here to tell you that there's a lot of hard asset-based lenders that will do it at 80%, but we prefer to do 70%. So every one of our loans is either 3 to 5 years on a longer amortization. The reason we do that is that we're funding your loan at a fixed rate, and we're borrowing from our bank at a floating rate. And the thing that, if y'all remember anything about the demise of the savings and loan business, the reason savings and loans went broke because they were doing 30-year fixed loans at 2 and 3 and 4% and funding those loans with 90-day CDs. So in other words, they're borrowing short and lending long. Well, guess what happened to the savings loan industry when prime went to 20%? Every one of them went broke. And that's when they started doing foolish things that just about wrecked the entire country. And I'll give you a good example. I personally participated. I did 3 loans with savings loan where I took a savings loan as my partner. But here's a fallacy with that. We built an apartment project in Pasadena, As I recall, it was like 240 units, and the loan was something like $4.5 or $5 million. Well, when we bought the property, we took a commission on the, so I'm going to the closing picking up money. So I got a commission going in. And then we were the developer, we were building it, we were the general contractor subbing it out. So I take a commission or a management fee for doing the construction. So I'm getting the 6% commission on the real estate, or 3, whatever was the case. I'm going to get a monthly check for supervising the work, and then the savings loan is financing 100%. And they said, well, if you're doing all of this, we're struggling here. We're about to go broke. They would add like 10 points, so they would charge 10 points. And they collected 10 points on the front. And of course, all this is rolled into the loan. I'm not going to the closing table with a dime. Well, think about that poor apartment project. They could have been 100% occupied back then at 85-cent rents when rents were 40 or 50 cents a month, and probably not service the debt. I mean, it was just idiotic. And of course, I wasn't too concerned about it because they were putting up all the money. And when I saw this happening, I did another deal. I did one with Alamo Savings out of San Antonio, and I did another one with a lawyer that owned a savings loan in Alvin, Texas. And I could see the market beginning, just like a year and a half ago, I started preaching about what's going to happen to our economy with oil under $40 a barrel. I've been saying that now for a year and a half, that bad times were coming. Well, I could see that bad times were coming. And I went to I forget that lawyer's name that owned that S&L. That was many years ago, 40 years ago. And I went to him and I said, look, I'll stay in the project. I'll still be your partner, but I want to buy back my personal guarantee. And we negotiated $250,000. I wrote him a check for $250,000. I had the check in one hand and my guarantee in the other hand, and we turned loose at the same time. And that thing went in the ditch, and they probably lost $2 million on that property. So I know about leverage, and I know about overborrowing, and I just don't think it's healthy for a guy to get too far leveraged. So if you're doing investment properties, you need to stay within some, I like to swim close to shore. I don't like the deep water. So. We ended the year with our total past dues, 30, 60, and 90, under 2%. And most banks, actually it was closer to 1.5%. Banks would die for that kind of loan today. And the funny thing about my business is, you're a hard money lender. Oh my God, you take undue risk. I make safer loans than the bank. I mean, in my opinion, if you do it right, they are. The safest loan I've ever made in my entire life is financing one's homestead. You get someone that's buying their homestead that puts 30% down and proves to us that they can service the debt. That's safe. We've never lost money on that type of loan. Not one time, ever. We got hard collateral. If you finance a car, that car can disappear. If you finance accounts receivable, I've tried to collect on accounts receivable. There's always some barter. There's always I owed that money, but he owed me money, and that offset. We had one in the Woodlands, what's the name of that subdivision? Carlton Woods in the Woodlands. This guy, the house, I think he owed us like $1.2 million or something like that on it. The house appraised for over $2 million. And I told him his first name was Carlos, and I said, Carlos, for God's sake, you can't even afford the taxes on this house. The taxes were $75,000 a year. I said, you can't afford that house. I said, put it on the market. Put it on the market, or I'm going to end up selling it. Well, guess what? 2 years later, guess who sold the property? I did. And all that equity, and they're just in denial. Again, there was a bidding war for that one, and we didn't end up with it, but it still only sold for $1.4 million, I think, $1.5 million. It's a $2 million plus house. But people are just in denial. But we'll do anything. I mean, if we're charging say we're charging 12% interest and we know they're in trouble, we'll modify the loan. We'll cut the interest rate. We've cut several to 7 and 8%. As long as they'll make the payment, that's what we want to happen. Because we don't want the property. We just want to get repaid. We'd rather work with the borrower. We'll modify the loan. Let me tell you, we're very ethical, and I mean that sincerely. We don't want your property. But we'll do anything. I mean, if we're charging, say we're charging 12% interest and we know they're in trouble, we'll modify the loan. We'll cut the interest rate. We've cut several to 7 and 8%. As long as they'll make the payment, that's what we want to happen. We do everything we can not to foreclose because we don't want the property back. But it happens. We foreclosed today, as a matter of fact. Our payoff was $161,000. Joe did the foreclosure, and it sold for $260, $270, $110,000 more than we were owed. So that's a heck of a deal. We just believe that if you're too highly leveraged, that's when you run the risk of getting in trouble. And we like for our borrowers to have some skin in the game.